Hey everyone, welcome to another episode of Into the Bytecode. Today I sat down with Mike Sall and Blake West, the two co-founders of Goldfinch. Goldfinch is a protocol facilitating uncollateralized lending, and it's being used by a growing number of borrowers in emerging markets. In this conversation, we talked about the users actually benefiting from Goldfinch on the ground, which I think is really cool because the project is actually doing good in the world. We talked about the complexities the team has faced, ranging from hedging foreign exchange rates to working within the regulations of different countries. Then we moved on to diving deep into the protocol and the design, hearing about their experience with shipping a production smart contract system that has millions and millions of dollars flowing through it. And we also talked about their recent experience with launching their token and decentralizing to open governance. Nothing on this show should be construed as financial advice. My guests and I may hold positions in the assets we discuss on the show, and that goes for this episode and any other episodes. With that, I hope you enjoy this conversation. So, probably a sensible way to start is just by describing what Goldfinch is. So if either of you want to take that, that would be great.
Sure. Mike, you wanna take that one?
Yeah, I think a good way to describe Goldfinch is also just share some quick background, which is that, one of the reasons I originally got into crypto was being excited about the potential for crypto to really expand access to capital and financial inclusion around the world. And I know those are kind of like buzzwords a little bit in the crypto space, but I really believe it. And while Blake and I were previously at Coinbase, we were just seeing a lot of the infrastructural pieces coming into place that could actually make it possible to have that kind of impact in the world. And so we really started Goldfinch with the idea of being this bridge between all of the capital that's sitting in crypto and borrowers out in the world who can put it to good productive uses who have traditionally been underserved. So the high level of like what Goldfinch is this bridge between all the capital that's in crypto and these borrowers out in the real world who can put it to work. And then sort of in crypto terms, Goldfinch is an under-collateralized lending protocol, which is compared to, say, Compound and Aave, where you need to put up crypto collateral in order to borrow other crypto assets. With Goldfinch, you don't have to put up that collateral. You need to instead convince the community, essentially, to determine your credit worthy and give you the capital that way. So that's a high level of what Goldfinch is.
That makes sense. So when you're talking about being at Coinbase and realizing that the infrastructural pieces were ready, were there specific things that happened that triggered this realization in your mind, or how did you actually choose to make that transition?
Yeah, I did. There was a few things. So kind of like late 2018, early 2020, Mike and I were first seeing, not first seeing, but like you were noticing DeFi was really starting to take off, right? There was just kind of these glimmers. It was getting to like the first billion in TVL. And I remember at the time, Mike and I being like, oh my God, there's $1 billion TVL in DeFi. This is so nuts. Like, wow, this is going to be like a real thing. And so, just that alone, right? This idea that now there was these users who had capital and they wanted to lend it out. They were starting to like seek yield and want to like do things with their crypto. Because kind of before that and before DeFi really got going, crypto was really just hodling. Like that was like pretty much what you did.
Hodling and very like long-term idealistic visions of
Yes.
It's going to, change nation states and whatnot, but not so much that was applicable right then.
Exactly. And this was kind of the whole magic of Ethereum, right? That was like, now you could really do stuff and build applications on top of the blockchain. And so that was one thing, just seeing that there was people starting to have this expectation of earning yield and wanting to do stuff. There was like this customer base, if you will, on that one side of the market, this kind of lending side of the market.
I would also, by the way, add to that thing about the demand. We were talking about this, in 2019 or early 2020?
Kind of like late 2019, early 2020, we started getting this.
Yeah. So this was before Compound launched Comp and started, I feel like, the whole DeFi summer with yield farming. And like technically yield farming already existed with synthetics, but it wasn't like a whole lot going on. But at that time, I think it was in 2019, Coinbase launched staking. Was it Tezos staking? I forget which one.
Tezos was the first one. I was actually working on that project while I was there.
Exactly. Yeah. And I was running the data science, like the product analytics team there, analyzing the numbers for that. And like a lot of people,
so you had kind of a front row seat to seeing how the adoption was coming through.
Yeah. And it was like notable. Like a lot of people were for doing that. And it was like, oh, wow, when you offer like yield to folks who have been traditionally just been thinking about hodling, like for me, that was a bit of a light bulb moment. Like, oh, that is like, this is like a huge thing in crypto. And then of course, once all the DeFi yield farming started during the summer of 2020, then it became super clear this was like a huge component of crypto. But we were starting to see the early signs of that, I feel like in 2019, early 2020, that like crypto holders looking for yield was like a massive sort of area that was still untapped.
Right.
Yeah. And we were seeing that as like, oh, Compound and Aave were starting to do this with the over collateralized thing. And we were like, that's awesome, right? But that's like a slice of the market. Only kind of, that's really for like margin traders, people who want to go like basically take leverage and go extra long on their hodling, or for people who've had a lot of gains and they want to get some liquidity, but still like maintain upside exposure, that kind of borrowing against appreciated assets. That's pretty much the use case for compound borrowing. And we were like, well, if we can do decentralized lending that's under collateralized, oh man, that's going to be like 100x, 1000x bigger market. So that was part of what was getting us really excited. And actually, to get back to Mike was mentioning some of these infrastructural pieces that were coming into play. One of the other big ones at the time was just stablecoins, and
Right.
USDC, Tether, but there was a bunch of stablecoins coming out at the time, even though those two are really the major ones now. And that was starting to pass. I don't know exactly what the benchmark was there at the time, maybe like 10 billion or something like that of volume. But we were like, oh, these stablecoins are real. There's like a pretty sizable amount of liquidity all over the world. And that really unlocks the ability to make loans to people in the real world, because before that, you're pretty much, what are you gonna do, lend out someone ether and like take all that volatility risk as a borrower? Like, you'd be kind of crazy to do that, especially if you're like a real business in the world who's like, they think about 1%, 2% on the interest rate. That's like can be meaningful to them. And so you can't have your borrow
the
asset like
yield
double
you're
in price.
getting is totally outweighed by the price movements.
Yes, exactly. So without some sort of stable asset there to lend against, it really didn't make any sense. There was like no way to do real world lending. So that was like another big piece. And then a third big piece was seeing how exchanges were starting to proliferate around the world, and you could turn crypto really easily into, basically any currency in the world. You had like Binance and Coinbase really starting to launch in countries everywhere. Latin America, Africa, Southeast Asia, all of them were starting to have solid exchanges with real liquidity. And that's also important because, the borrowers of Goldfinch, they take the crypto from the smart contracts, like USDC, and then they go to whatever their kind of local exchanges and turn it into their local currency. And they use that in the real world. And so we really needed all three pieces. Otherwise, it would have been just operationally and infrastructurally like much more difficult to build this business. And I don't think we really could have done it before, mid 2020, which is when we launched.
Right. Interesting. So you're partially relying on the local exchange infrastructure in these different markets where the borrowers exist, right? Like how, maybe let's move to talking a bit about who the actual borrowers are, right? So the borrowers are, mostly credit funds who are focused in these different geographies and are borrowing USDC and then kind of doing their own underwriting and due diligence for like totally different verticals and types of more like low-level borrowers, right?
Really, I think it's easier to think about the borrowers. You're right, like these credit funds are coming on to Goldfinch and they're a huge channel for scale of the protocol. But I think it's easier to kind of think about the borrowers as fintech companies around the world in these different markets. They're the ones who are really using the capital that gets borrowed. And that whole piece was actually like just a big part of Goldfinch from the beginning, because we did a lot of customer calls as we were thinking this whole under collateralized lending thing. We were like, yeah, okay, but like, where's the borrowing side? Like the lending side was easy. There was just so much money in crypto and everybody wanted to earn yield. That was like obvious. But then the borrow side, when we were talking to people initially about this idea, they were like, oh, well, like maybe it's crypto miners want to borrow. Maybe it's individuals who like are shut out of the credit card system or something like that. That was kind of the easy answers that people had. But we would talk to people and we kind of, dug into that more, and like just none of those really kind of made sense. Either people didn't really want to borrow, or the other options available to them were probably better than what crypto could offer, because crypto still had a lot of its own disadvantages of, user experience and gas costs, and like it's slow. I mean,
a lot of like non-trivial obstacles there.
Totally. And so we were like, no, we need somebody who has like a huge pain point so that they're really willing to go through all of those non-trivial obstacles. And I've kind of had this like general longstanding interest in microfinance. Eventually I was like, oh, I think there's a lot of companies in emerging markets who don't have that same level of access to capital. They might be willing to jump through a lot of these hoops. And we just started reaching out to those businesses through some people in our personal networks. And we talked to dozens of these businesses before starting Goldfinch. And we just kept hearing that same story from them, which is, I spend half my time trying to raise capital, despite the fact that I have a profitable business and I have a lot of track record. And what we came to realize is they were kind of falling into this gap of financing between, like, say, 500K and maybe like $20-ish million, where, like, if you wanted to borrow less than that in, a lot of these other countries, not in the West, their capital markets just aren't as developed. The pools of capital aren't as deep. And so, if they wanted to raise less than 500K, that could probably be done. That was like maybe pretty easy. They talk to family and friends, or there's some investors there. You want to do more than like 20 million or something, now you can start getting the attention of bigger institutions who are, in Europe and America.
More global.
Yeah, more global, exactly. But there was a huge gap there in the middle where it was just really hard to get capital, and it wasn't really commensurate with the risk of the business or the track record of the business. Like, they sort of should be able to get capital. And so we thought this was like a really good wedge to get into, where you have all this money in crypto, doesn't have a lot of other opportunities for earning yield, especially stuff that's uncorrelated with the rest of crypto. So we thought we could offer a unique product there, and that they would be willing to lend to these places all over the world, because most of the crypto community is like so global anyway. And so that was kind of a thing for us. We're like, we think this is a really good, unique borrowing market to get started with. And that was initial. I feel like, I'm not sure what the tangent brought us down this. There was like an initial question.
That's super interesting.
But
it's kind of surprising in a way how disjoint the global like capital market is, right? In a world where I feel like everyone's kind of chasing yield, chasing returns, and going through a lot of effort and like a lot of lengths to get a return. But then on the other hand, you see this in the venture world too, where like startups that are based in other geographies just don't get the valuations that startups in like the Valley do. And that's kind of starting to change also, but it's interesting how much geography is still a barrier.
Yeah, you're totally right. And this was something we heard from just not companies. We also talked to just a bunch of, you might just call experts in the field, people who've dealt a lot with financing in emerging markets over the years. And we heard that over and over again. There's just so much kind of, I don't know, geographic bias, or just like you sort of, I don't understand that market. So like, I don't want to go touch it because I'm not really sure what's going on. And I think a lot of that is starting to change slowly. Crypto is helping, obviously remote work and just virtual everything is helping a lot there, but it's still there.
Yeah. And so who are some of these borrowers then? Because there's some like really interesting stories that you've published on your blog.
Yeah, I can share some examples. So one of the borrowers is a company called Tugende. They're based in Uganda, but they were looking for capital to expand their operations in Kenya. And what they do is they provide rent-to-own loans for motorcycle taxis. So kind of like the Uber of Kenya for like taxi rides there. They're on motorcycles, and they have like tens of thousands of customers who get these loans for motorcycles, and then they pay it off over a couple of years, and they're able to make a living by doing these kinds of like taxi ride shares. And yeah, so Tugende is one example. They borrowed like $5 million to expand their operations in Kenya. They're already like very well established in Uganda and like expanding throughout Africa. Another example is a company called DiviBank. They're like the kind of like a clear bank of Brazil, and they provide working capital loans to small businesses in Brazil. And so they've borrowed money now to be able to make those loans. And then a third example is a company called Greenway. They're in India, and they have a really interesting thing. They have these sort of like eco-friendly cook stoves that they provide to low-income households throughout India. And they make money on the carbon credits that they get from those cook stoves because they're carbon friendly or eco-friendly. And so they have a loan to expand their operations there in India and even beyond. So those are like three examples. And it's like we were across all of the fintech and lending businesses that the capital's gone out to. There's now over 230,000 borrowers who are like receiving capital now, and it's
this
cool.
Is like and like, would you count the motorcycle taxi owners as a borrower?
Yes.
Like end users?
Yeah, being financed by the loans.
That's so cool.
They don't even know probably that it's like crypto capital that is helping them grow their businesses or get their cook stoves and things like that. But yeah, it's very cool that like now like all of this crypto capital is like actually in the hands of these folks, allowing them to grow their businesses.
That's so cool. So you actually get to feel that you're doing good in the world, and you really are, right? Like,
Yeah, I think going back to Blake's description of like us targeting this market, it was like a win-win because from an analytical standpoint, it made sense as like an initial market to go after, but also from like a mission standpoint, it was like, oh, from like day one, we can be achieving the impact and mission that we want to have at the same time that it like makes the most sense from like a go-to-market strategy too. So yeah,
that's
it's
so
really
cool.
yeah, it's cool.
So then these borrowers like Tugende, right? So
Yeah.
are they directly interfacing with the Goldfinch product and protocol and then kind of abstracting, like absorbing all of the crypto complexity and then abstracting it away from their own users, right? So they
Yes.
take in USDC, they convert it to their local currency, they like they have like substantial crypto operations under the hood, I imagine.
Yeah.
Yeah, by substantial, I mean, so Tugende, yeah, they set up their own MetaMask and we connected them with an exchange where they cooked up their bank account like a typical like centralized exchange. And so then they use MetaMask to draw down the USDC and send it to the exchange and then yeah, like basically withdraw that capital to their local bank account and then they handle it from there in fiat. And yeah, so Tugende is doing that. Give the example of Greenway. Greenway is going through the credit fund Almavest. So in that case, Almavest is like the actual borrower on the protocol, and they have their own exchange account, and they get the fiat, and then they send it to Greenway. So it varies, but like DiviBank and Tugende, they're both setting up with MetaMask and using the protocol.
That's cool.
Yeah.
And how have their experiences been? Like, are you on the phone, like doing customer support for MetaMask, like for someone based in Uganda?
Yeah.
Yeah, we've done that.
Not us. We have some great team members. I mean, actually, Blake and I were doing it early on, but yeah, we got on the phone with them. Also, want to make sure that like they hit the buttons correctly, and don't like accidentally
right, because there's no recourse. We can't get it back.
Yeah, you put in that address wrong. Oof, it's all gone.
But interestingly, like Tugende, for example, afterwards, I think we had like a couple small little hiccups in the process, and then we were chatting with them. They're like, honestly, this was way better than anything we've like.
Right. Oh my God. Yeah. Comparing it to like the documents, passing Word files, passing back and forth.
Or fiat banks and
even they were like supposed to receive a wire and it got lost in like, I forget what country it was. There was like some bank in another country that like lost the wire or something. I had to like redo it. And it was like a whole ordeal versus crypto. They see it like, within a few minutes, basically right there.
I remember them even, they told us, like, I think I remember like they were trying to draw down and we had some bug on the front end and it took us like a few hours to like end up fixing it and saying, oh, you got to come back and do your drawdown again. And they did it. And then they were like, yeah, we once had a bank just hold up our funds for like 9 days just to like ask more questions.
I mean, it happens in the Western world too. It's not even a foreign concept.
No. Still, they were like, oh, this is still way better.
Yeah. Wow. I wonder what kind of other second order effects this will have too, to have, entrepreneurs on the ground and like businesses start to actually use crypto. And, you're probably seeding this level of interest that means that now they're going to go explore what else is happening. And
well, it's funny you mentioned that. We've worked with businesses in Nigeria since like the very beginning. And their crypto adoption is really taking off. It's like one of the highest sort of like, I guess, densities of crypto users in the world. And, they were mentioning to us that just as businesses, they wanted to keep more of their currency in a stable coin because they were kind of concerned about inflation of the Naira, which is their local currency in Nigeria. So businesses were doing that. They were also telling us that their customers kept asking them like, hey, can I get crypto with you, or can I just like hold money as stablecoins or something with you? And so they were talking to us about like, what APIs can I use to make products that like will use crypto. They just kind of wanted to get our opinion on that and say it's not something that we do at Goldfinch, but they are getting super interested in this, and the users in like the people on the ground in Nigeria are getting super interested in that. And to us, that was like, for Mike and I, we felt like, oh, this is kind of the canary in the coal mine, right? Like eventually everyone's going to be pretty interested in this. And if the users start having crypto accounts and the merchants start having crypto accounts, then like eventually they're just going to be able to transact with each other natively, like through crypto.
Totally. Like leapfrog the old kind of financial infrastructure and just move straight to crypto.
Yeah. I think that whole like vision seems like it's getting closer, right? You really need the L2s, right? Like you can't, Ethereum is just like so expensive right now that people in Nigeria can't be sending any money to like a merchant on that. But we're getting there, right? All the L2s are starting to get pretty real. And so I think, within the next maybe 18 months or so, we can start to actually see some of that more like retail usage. I'm
And the
hopeful.
particularly interesting thing is that a lot of these people, you'll know that they're, unique human beings, right? Because of like the KYC that
Yeah.
like say the borrower lender is doing on them. And so
Mhm.
that opens the door to, I don't know, like UBI of various kinds or
Yeah.
voting, like various kinds of governance on the local level. It could be really interesting.
Yeah, it's really good. And, I mean, that's another thing we've been doing at at Goldfinch. And we released that product a couple months ago called UID, which is this NFT for representing ID on chain. And we, wanted to do it for all the reasons kind of you're mentioning here. It opens up a lot of design space on protocols and on voting. So we're actually now doing quadratic voting now that we've released our token. Like that's only really possible because of this UID, which represents the fact that a user has been KYC'd on chain. But other protocols can use it. They're free to integrate it into their designs as well. It'd be totally free for other protocols. The other stuff you're mentioning, like UBI and that kind of thing, I think to me, that's one of the things actually really exciting about crypto generally is like if individuals and businesses start having sort of known public accounts on chain, the types of like philanthropy and the types of the things you're mentioning like UBI, like all that stuff becomes just so much more efficient than it is now, right? Like you have things like
Totally.
give directly. I don't know if you're familiar with them, right? Like
Yeah.
they just give money directly to people in villages and stuff like that around the world. And it's like, it's not even that much money. They give them like $1,000. And that's like the
Makes
equivalent
a
of like
huge
4
difference.
years of salary for them. And they can like, it can be transformative. And like, that's hard. You have to have a whole organization and all this overhead to like make that work. But if people just had crypto accounts and you kind of had confidence that it was going to them, I feel like the amount of outpouring of philanthropic support from the West going to these other places would like increase significantly. I mean, that'd be my hope. Who knows? But
Yeah, just having legible addresses for anyone, even in the Western world again, right? Like a musician
yeah,
having a known ETH address that you can send funds to just because you're vibing with what they're doing
yes.
is like there's no way to do that right now. You have to listen to their music or buy their merch or something like that. And so just a direct link is super valuable in its own right.
Yeah, especially when you talk about global stuff, right? Like it's one
Yeah.
thing, in America, maybe you go see someone live and they put their Venmo on like a little sign or something. But everything, especially on the arts, is getting so much more digital and global. Like that, they can't do that for their fans who are in like Europe or India, right? It's harder. And I think you're right. ETH is like such a great way to do that kind of thing.
So when you're thinking about more like global adoption of crypto in these emerging markets, like what are the real gating factors of that right now? What are the bottlenecks? Like layer twos is one because the gas fees are too high.
Hmm.
Are there any other things that are fundamentally missing that would be needed before this all happens?
I would say a couple of things. Well, one is the hedging of the foreign exchange rates. So when all of the, like, for example, Tugende, they need to get hedging instrument, and also like companies in Nigeria need to get like hedging instruments to hedge against like changes in the price of naira, like just the local currency, and that's really hard to do today. You have to
Oh,
usually
interesting. So when they lend it out, the price could change on them. And then when they come to pay back their loan in USDC, they might not be able to, even if there's been no kind of default or anything on their side.
exactly
Yes.
right because they're borrowing in USD terms. I mean USDC, but it's USD terms, but they're lending out in different currency,
Oof.
and it's just like standard practice to require. I mean, and also just good practice for all of these borrowers to hedge the exchange rate through like forwards, I think, or futures. I forget how they do it, but it's expensive and it's like really hard to set up, and you have to have like good relationships with the banks. And so if you're a small company, the idea of like getting into all these hedging instruments is like a huge hassle. And so part of what's good about working with credit funds a little bit is they sometimes have good relationships already set up and they can like help get that in place. But that's a big hassle. And we've talked a lot about, oh man, if like how could you do that with crypto potentially? If you started to have actual stable coins in all these different currencies on crypto, then you could start creating just like automatic hedging instruments and derivatives so that we could just solve this kind of in an automated way, which would be like amazing for these companies. But right now, that is like a real kind of hassle to get started. And then a second big hassle is all of these areas, they have their local kind of like lending regulations where you have to register certain things. So for example, in Brazil, we have to set up all these special kinds of accounts and you register it in certain ways. Same thing with like Kenya, Nigeria, you have to register it with the government. And so that's another reason why it's been helpful working with credit funds who like are already familiar with these different jurisdictions, because they kind of like manage that process and make it a lot easier. But those are two big things where if over time we can kind of make it more automatic or like make like templates of how to do things more easily, that will be a big help. But that's been like a big kind of like friction for us to get through on these initial deals. But a nice thing is that it's like once we kind of figure it out in one country, like once we have something working in Kenya, then it becomes
and it
much
works for
easier
everyone
to do a lot more deals in Kenya.
Yeah.
Well,
On the,
yeah, go ahead.
I was gonna say on like the retail side of adoption, I think it would be probably pretty helpful if we saw more stable coins and more currencies. Because I think a lot of people's daily life, it's not in dollars. And even though a lot of people might like it to be in dollars, and that's kind of what was happening in Nigeria that I was mentioning, they want their lives to be in dollars, but a lot of countries it's not. And I think for crypto to really take off, they're going to need their own version of a stable coin and the currencies around the world so that merchants can feel good about accepting it. You know, they're not going to want to deal with the exchange risk that Mike's talking about by accepting some currency that they don't pay their taxes in.
Yeah. And have you looked into like how that might be possible? Like are there stable coins in some of these currencies? Like what are credible paths for getting there?
We've started to see some notion of other stable coins. I mean, there's like, you know, things like the euro and the yen, I think have their versions of stable coins right now. There was some company that was like pitching one of our borrowers that they were going to have like a stable coin of the real, which is the Brazilian currency. Yeah. And I haven't seen a ton of others. I'll be honest, I haven't been keeping my ear too close to the ground on that one. I would imagine it'd be the same thing as, you know, what Coinbase is. The centralized path is so easy there.
Right.
And I also feel like it's something that governments can get like a little bit more comfortable with. Like they still have an arm's length way to talk to, you know, Coinbase in the American example, or other banks around the world who may want to do their own currency. Of course, you know, you could do a decentralized one as well, some sort of like, you know, you could have like a DAI, but that's pegged to whatever currency you want in theory, right? There's nothing that stops that from happening. That has all its own problems. You know, it's less capital efficient to do that kind of thing.
Right. Yeah. If you can design some sort of a programmatic algorithmic stablecoin design, then you could anchor it to anything at all.
Yeah, I feel like that's still the holy grail that's missing in crypto.
This is making me think of like a broader kind of macro question, which is like, which do you think is more likely to happen first? Like a whole bunch of stable coins in different currencies around the world, or increasing dollarization of some of these kinds of economies potentially? I feel like there's like two paths it could potentially take from like a big macro view, is you end up just having like hundreds of stable coins in different currencies, or you have dollarization with like USDC or other kinds of stable coins.
Right.
In these markets.
What's your thesis on that? Have you thought about it much? Well, it feels like the dollar is kind of in danger in its own way.
There's, you know, more inflation and stuff, and you know, if you're a Ray Dalio disciple, he would say the dollar is going to be, you should be short the dollar over the 10-year horizon.
My personal view, it would be like larger economies will probably have their own stable coins, but like a lot of the markets we're going into, they're smaller economies. And so to me, it seems a little bit more plausible that they just start using USD stable coins versus creating a whole, like for example, like in Mali, for example, I'm no expert in Mali, but like the idea of like a local stable coin there sounds less likely to me than like adoption of other existing stable coins.
Yeah, it'll be very interesting and like kind of path dependent how all of this evolves too, and how the different governments react to it. Because if I imagine it's happening to some extent by people on the ground using USD, but then for the government, it means that you lose control of your monetary policy,
which is a big deal.
And is why in like Venezuela and Colombia and stuff, they limit, like you can't actually like buy too many dollars, right?
Yeah, right. I mean, I actually think from the US's perspective, it would it might be there's sort of the enlightened path would be for them to actually encourage this dollarization through
Right.
stable coins around the world, because that would just drive more demand for dollars and generally keep the prices up. And it's also a thing where, like, that's not like it's like a diplomatic thing they need to like push. They can just sort of let it happen, and it would just happen. Yeah.
Yeah. So one of the things that's been interesting about Goldfinch for me is that I think a lot of people building in crypto kind of, probably rightly so, gravitate towards very crypto internet native type ideas that minimize their touch points and interface with the real world, because that's just going to involve a lot of complexity. And like we've talked about some of this complexity, right? Of like the exchange rate risk and, all of this sort of stuff. So yeah, I'm curious, like has it been harder, easier than you expected? How's that all gone?
I mean, I'd say, like, broadly, I think one of the things Mike and I have talked about is that this real world thing, it is harder because it has these frictions that we're mentioning, and it has these complexities and more like, legal and regulatory issues and stuff like that. But when things are harder, that's also where opportunity tends to be.
Right.
And so we kind of think that's an advantage. It's a place where a lot of other entrepreneurs in the space maybe don't want to even touch, right? They're just going to have a sort of, I think Paul Graham has called this like schlep blindness. They're like, oh, it just feels like a schlep. I just don't really want to deal with it. And so we think that's part of an opportunity. And I also just think kind of more broadly, like, crypto needs to get into the real world, right? Like, there's just so much economic activity
at some
here,
point
and so
we
much
need to
value.
cross this chasm.
Yes, and whether that's us pulling it in to the crypto world or crypto sort of expanding and pushing out, it needs to happen in some way or another. So I think it is harder, but I think that's where the opportunity is. That's part of why we're kind of excited to be doing it.
Yeah, I won't speak for Blake, but I think we kind of like viewed it as a feature of
As a
doing
positive.
like we want to go and do something super hard because we're ready to like really work on something that's really hard. And then that's where the bigger opportunity is, and like probably like less folks all trying to do the same thing because it's so hard. And getting into it, you said, how does it compare with expectations? My expectation getting into it was that it was going to be like extremely difficult. I would say compared to my expectation that it was going to be really, really hard, it has been easier than I expected. And like what I would say there is
relative.
like there's I feel like something we didn't quite grasp when we started is like there's a lot of people who are like rooting for something like this to exist. And like when we were talking to the early borrowers and like at the end of the phone calls, they were like, hey, let me know when you have something ready because we wanna start borrowing from this thing. Like there's like a lot of like momentum and energy, like people actually really want it. That like once we started having versions of it, it was easier than I expected to get folks who wanted to participate and like try to make it work. And a lot of the early borrowers and partners that we're working with, like they're brainstorming with us, how do we make this happen, kind of. And like so like it's like, yeah, it's hard, it's uphill, but it feels like we have more folks all trying to like make it work because we all want to like see it happen. And so that was something that I wasn't totally expecting, and that made it frankly easier than I was sort of prepared for, essentially, because I was just thinking this is going to be just crazy difficult to get off the ground.
Yeah, it's like that thing of building hard things is sometimes easier than building easy things because you get people excited, like people want to help you.
Yeah. That was also, I would agree. That was something that was surprising. Was just sort of, it was almost like people were like waiting for someone to like say the idea, and then they're like, yes, you should go do that. And
like, I don't want to go do this because it sounds really complicated and hard, but I will root for you.
Exactly.
Yeah. We had I think more than one investor turn us down, being like, I'm not sure if this will work, but I really, really want it to work, and you guys should know that.
Right.
Yeah,
that's awesome. Yeah, I mean, well, it's definitely one of the good like positive stories, one of the positive crypto stories. So one part of this interfacing with the real world that I wanted to talk about was on the legal side, right? Of like interfacing with all of these different governments and the US government where you're based, I think, and or the company has been based. I don't know how the decentralized protocol is structured. And it seems that you've kind of consistently taken the path of working within the legal system, right? Like doing things that are compliant, you're doing the KYC, you're doing the UID. So I'm curious how you've thought about this path, like maybe what some of the specific constraints that you've had to design around have been, what it's been like interfacing with other countries, if that's at all been, relevant to this point.
Yeah.
Yeah.
I was gonna, I like when I think of the biggest constraint, it is actually, it's less from our perspective as creators of a protocol. It's more from the perspective of the borrowers who want to use the protocol. So these are fintech and lending businesses that have pretty stringent regulations and compliance requirements in their different jurisdictions. And the biggest one is around AML and KYC. Like they can't take money from folks who they don't know who they are. So when we decided to get KYC implemented in the protocol, that was less of us thinking from, oh, it's a protocol, like what does a protocol need? And more from thinking like, what do these borrowers need to get comfortable borrowing from it? And like they need to see the KYC there because they have much more stringent requirements than like crypto degens around the world. And so that has been, I think, from the like regulatory and like the legal perspective, the biggest lift for us is really trying to think through the borrower's needs in all of these jurisdictions and like how do we make sure the protocol is going to work for them so that they're willing to grow with the protocol.
Yeah, I would just kind of add to that part of the reason that we find that really is really important is because we want this to be really decentralized. Like there is a different path that other protocols, won't get into like names or anything, have taken where like the protocol is totally open and is, there's no KYC and it's all anonymous and stuff. But the borrowers who are companies, guess what? They still have the same concerns. So the like centralized company that's like helping to build some of that protocol, they bear all that risk because they sign a deal directly with the companies who are borrowing from the protocol.
Right.
And like that path is available. It's actually kind of the easier, obvious path. You don't build this thing in crypto.
So in that path, you'd be signing like an off-chain contract, kind of assuring them that like you're going to give them some subset of the liquidity that's KYC AML.
No, it would just be that the company, so like the borrower, like it would be as if, Tugende, to use the example here, or just whatever fintech company signs a deal with some company, and like that company is sort of the lender there, right? So that company has been KYC'd and that part's fine. The borrower doesn't have to ask questions about where, they don't have to go like multiple levers or layers beyond the chain, you know what I mean? So like that centralized
that's centralizing, right? Because like that company owns the, right.
Yes, and that's all anonymous over there. So that company is really taking all that KYC risk. But to us, like that's not a decentralized protocol. That's just like somebody raising money from the crypto sphere and then lending it out in a centralized way. And we're like we really want to build this decentralized thing. That's why like we are not involved in any of the deals in sort of like the legal way. It's these borrowers going directly to the community of backers, right? And the community of backers therefore have to be KYC'd because those borrowers have to know where they're getting their direct money from. And so yeah, I think it can be a little sort of non-intuitive tool, but just like the KYC is what enables the true decentralization.
Yeah. So have you baked the KYC into the protocol, or how would you think about like there could be another level of abstraction on this where like these different stakeholders could interface with each other in a non-KYC'd way, but then like they could opt to only kind of take counterparties that have the KYC. But then on the other hand, I imagine like a lot of the core incentives and like security considerations of the protocol around like Sybil resistance, like, collusion, like all these things fall apart if you don't have the UID, right?
That's right. So the whole trust through consensus mechanism, which we haven't really talked about much on the show, but is like this kind of core part of Goldfinch, that it requires Sybil resistance, right? And so we knew kind of from the beginning we were going to have some form of Sybil resistance and ID. That doesn't necessarily have to be KYC for that part to work,
right? But
it turns out that KYC is pretty good at that, and our borrowers need it for compliance. So it sort of killed two birds with one stone. And so that was kind of why that decision is there. And it is in the protocol, like it's on chain that the lender, the individual, the backer has to have this KYC sort of NFT that we have, which is the UID. But it's built in the protocol in such a way that they can sort of swap out any provider of ID that the protocol wants, right? We sort of think about it a lot like stablecoins, right? Like the stablecoin USD is centralized, but any protocols just use that, right? And like that doesn't make the protocol not decentralized, or it doesn't make the protocol centralized just because they use a centralized stablecoin, right? And in the same way, like the KYC is provided by Warbler Labs, which is an alternative company that does the UID thing, and Goldfinch protocol happens to use that UID product, which is provided by Warbler Labs, and
But
they
that
could
piece
use,
could be like abstracted away. It could be like
yes,
any number of these UID equivalents could be used.
exactly. And many are going to come up, and the protocol may decide to switch to another one if it seems like it's a better option for whatever reason.
Right. It makes sense. It's like threading the needle between like, yeah, like interfacing with the real world and being like native, you know, doing what's needed right now for these borrowers versus what could be the ideal in like X number of years when there are other like Sybil resistance or like proof of unique human type methods out there.
Yeah, exactly.
And I think like I personally think a big part of the future of crypto is going to have this kind of like KYC on chain in some form. Because early on when we were working on this, like we were trying as hard as we possibly could to not require KYC on chain. And but like the more we talk to the borrowers, we're like, this is just a straight up blocker. The only other option is like what Blake described of like we just set up an entity and that entity does all the loans and then that entity takes on all this risk and it's not actually decentralized. And like there's no way, like we can't imagine a future world where protocol can actually serve like a substantial portion of global debt in the world where it requires like an entity like that to be sort of like in the center. So whereas like it's going to require KYC on chain for what we see is like Blake mentioned 100x, 1000x of the kind of lending we already see on crypto. We're gonna need that KYC on there to make that happen around the world and with the kind of impact we want to see. So like my personal view of it too is like it doesn't feel like it's taking like it doesn't feel like a big trade-off because I think the future of like a big portion of the future of crypto that's actually serving real world activity will end up having some version of this on chain. I don't know if it'll be exactly like the way we've designed it up front. It'll probably change over time, but yeah, I view it as like just getting an initial piece in place that's going to help like get to the next stage of like the broader sort of crypto landscape.
Totally. It's definitely a needed stepping stone in the least and like potentially relevant longer term too.
Yeah, I actually kind of personally think that this whole like ID piece, whether it's KYC or other forms of Sybil resistance that are starting to pop up, I think this is going to be like a big sort of growing theme of the crypto landscape over the next year and 2 years, because not only does it enable, KYC specifically, I think enables a lot of real world use cases that are dicey now, and specifically getting enterprises on and institutions on who have just so much capital, right? And like this KYC thing is a real blocker for them. And like, I think the capital is totally worth it, in my opinion, for the growth of crypto long term in this trade-off of doing some KYC. But also it just enables like so much more design space for the protocols, right? You can do things like referral programs better. You can do so much more interesting governance systems. You can do so much more interesting like voting things like and quadratic funding and like protocol funding of like public goods and stuff like just so many things require ID and some form of Sybil resistance. And even our stuff like trust through consensus, right? You just can't do that kind of stuff without some notion of Sybil resistance. And so I just think without it, you're really actually handicapping your design space, which is only going to get more there's going to be more opportunity cost to that as we start having L2s, which also just expand the design space of what like developers can do and the gas costs and stuff. Also things like just being able to have like NFTs that are like specific to an address for things like vesting and these other sort of design things. Like all this is very sort of address specific. And I think L2s and Sybil resistance stuff are going to add a lot of this design space, and protocols are going to want to use it.
Totally. And so the way this the UID works, you're using a third party to do the KYC, right? Mm-hmm. And none of the information is stored on chain, obviously.
Yeah.
But then is the company, does that have like the kind of underlying data or does that all kind of stay with this like third party right now?
Yeah. So Warbler Labs is the company that handles UID, and they have like basically all the real data is stored with the third party, who is Persona. That's the name of the company. And Persona has like super stringent Yeah, super big clients. They're a really, really large company, and they have super stringent security policies and data, storage policies and stuff. So, we feel really good about using them. And then Warbler Labs sort of handling the on-chain aspect.
Got it. So they just kind of like ping you back, and they're like, yes, this is the real person. Yes, they're unique. They haven't signed up before. And then you kind of take that and map it to Ethereum.
That's right. That's right.
Yeah, that makes sense. One question that came up for me, so when you're talking about the borrowers needing this KYC, so taking the example of Tugende or another one of the borrowers, like, are these, is this an entity that's established in Uganda, or do these borrowers kind of set up US entities just to be able to borrow from this market? Like, what does it look like under the hood?
So it varies. So a lot of these, like Tugende, I think they are a Uganda entity, I'm pretty sure. And for example, we worked with QuickCheck, and they are a Nigerian entity. Aspire, they're in Singapore. They have, I think, a different entity, but they're not US. There
That's
are
so
some of these
cool.
companies, what they do is they do set up, some of them will set up US entities so that they can get funding from US institutional investors, because
Right.
US institutional investors find it way easier to fund to other US entities than to set up a whole operations around understanding Nigerian law and like what has to be registered there and things like that. So the more established businesses that can afford to like set up a US entity will do that and have the time to do so. But a lot of these companies, they're in their local jurisdictions, and they'll often, like, a lot of legal agreements will go by like London law or even like US law rather than local law, but they still have their entities set up locally, and you still have registration requirements often with the local governments.
That's so cool. So you're really like kind of acting in this international playground.
Yeah, it's in 18 different countries right now.
Yeah.
Yeah.
Sweet. So yeah, maybe let's move to talking about the protocol, because I am curious about digging into some of the design decisions. Like,
Yep.
maybe a good starting point would be to describe like the brushstrokes of how it works, and also has it changed? Has it evolved over time?
Yeah. So I can give some of the broad brushstrokes. There's three main actors in the system. There are borrowers, there's what we call backers, and then there's LPs. And so we've talked a lot about the borrowers already. There tend to be these fintech companies, though there's nothing specific in the protocol that requires them to be fintech companies in emerging markets. That's just who the initial market is. And then the backers are, you can think of them as sort of like active investors. And so they look at specific deals, they assess the risk of a company, and the companies, they'll present tons of information to the backers. They have these data rooms, they have Discord channels where people answer questions, they do YouTube live AMAs, they show their track record and all sorts of stuff. So backers can use all that information. That's all off chain to assess the risk. And the backers put money into a specific deal. As I was saying, they will for that get like a fixed rate of return, whatever that is, often between like 9 and 15%. Then there's these LPs. And so the LPs are putting money into a senior aggregated pool. We just call it the senior pool. And that money is more passive. It's kind of, quote unquote, set it and forget it. And it earns a lower return, but it's diversified across all of the borrower pools. And it has these backers as kind of first loss capital. So an important thing to understand about between the backers and the LPs is that backers are first loss. So, in traditional finance, you call this like a junior tranche and a senior tranche. So the backers are junior, and the senior pool is, not surprisingly, senior tranche. And so
the backers have a lot of skin in the game.
They have a lot of skin in the game. And this then is the whole reason why the protocol uses this idea of trust through consensus to say, if we see enough backers putting their own hard-earned money into a given deal, then we can trust that that's probably a pretty good deal. And therefore, the protocol can automatically allocate capital from the senior pool into that same borrower pool that the backers have been putting money into. And so, typical kind of leverage ratios, as we call them, might be like 3x on that. So like roughly 25% of the capital would come from backers and 75% would come from the LPs or the senior pool. So like, just as an example, right, if there was like $1 million deal, 250K would be coming from backers, 750K would be coming from the senior pool. And part of the economics that make all of this system work is the idea that the 20% of the interest from the senior pool is reallocated to the backers. So the backers end up earning
20% of what?
of the interest generated by the senior pool is reallocated to the backers. So this, depending on the leverage ratio, it'll like vary slightly, but backers will often end up, they can be making sort of like a 15 to 20% interest because of that reallocation of the interest. And so that
It's
gives
like a
them
fund
incentive.
model for them where you're sourcing all of the capital. And if they perform, they take a performance fee on it, basically.
That is a way to think about it. Yes.
But
And
they
so
also get to lose. They don't only get to play with other people's
Yes.
money. They also get
They
to
do not
lose
get to-
if they
exactly.
don't do well.
They have to lose. Right.
They have to lose. Yeah, all of their money gets lost first before $1 of the senior pool money gets lost. Right. And so, but that's their incentive, right? Do a good job and they can make this outsized return on their money, and do a bad job and you lose all your money. So, the economics are aligned with everyone. And this is why the senior pool can kind of get comfortable following this like wisdom of the crowd from the backers.
Yeah. So these backers, are they also kind of existing, research and due diligence, like underwriting firms, or are there like net new backers entering the system who are doing this for the first time?
It's both. We've seen sort of traditional finance people come in who have a lot of experience looking at deals like this. We've seen them be backers, and then there's also a lot of what you might call crypto degens, individuals coming in and taking a look at these deals because they're offering solid stablecoin returns and they want to get in. Yeah.
Right. And I would add to like this, the community of the backers is something we're still in the early stages of kind of forming and learning who are the kinds of folks that are gonna find this to be most compelling and want to spend the time evaluating it. So like I would say over the next year or two, I wouldn't be surprised if the composition changes as we potentially attract more folks from traditional finance involved, and then help educate existing folks and like see new people from the crypto space come in. And so, but yeah, our hypothesis is that it will be a combination of sort of new folks learning how to evaluate these borrowers, because we're learning it's like it involves some education, but it's not like crazy. It's definitely like a learnable thing. Plus, getting folks who've already been doing this, like existing analysts in traditional markets, to want to participate in crypto because the economics are really compelling. And so I think that's going to be like we see this early sort of stage of folks who are participating, and then I'm like personally very excited to see how the community kind of evolves over the next year or two, and like how like the processes and norms get formed.
Yeah. And so while this is kind of in the earlier stages, or like before decentralizing and opening the system, I imagine you can kind of be more hands-on with who the backers are, who the borrowers are. But I imagine that the intention is that like people can literally come and start using the protocol, right? And not really interface with the core Goldfinch team. So what are the incentives at play here? I imagine the borrowers, right? Like if you truly are a, fintech in an emerging market, this is basically your, you have access to this capital pool. And so you really care about that. You don't want to kind of like mess that up. I know you have this concept of like auditors. I know there's like the junior tranche. Like how do you think about these different pieces and what the risk model is here?
We can talk about the auditors and get into sort of what their place in the protocol is. So the auditors, their main job really is to handle and prevent fraud on the system, right?
Mm-hmm.
And collusion in the system. So, borrowers could, for example, collude with backers to sort of fake consensus and then essentially steal all the senior pool capital that comes in on top. Right.
Like you and your friend could do the KYC, could like go into the protocol, and one decides to like underwrite the other, and then you get a leverage ratio from the senior pool.
Exactly. That would be like the kind of most obvious and like worst kind of fear of the protocol in general, that would happen. And so this is where, the trust through consensus thing comes in. Like, okay, yeah, I guess you could do that with one friend, but like, can you do it with like hundreds, right? And what is the number of people that it's going to take to actually, be able to get real leverage in the system? And so those like exact numbers are kind of, still being figured out, but like it's probably gonna be substantial, right? It's not gonna be like you and your friend who can then get like 3 or 4x leverage ratio. And so,
oh wait, because multiple backers need to kind of confirm the deal.
Yes, multiple backers need to put into a given deal in order for the protocol to consider that like trustworthy.
Got it.
It's worth pointing out the general sort of model is that leverage ratio increases as the number of backers increase. So
Right.
It's like directly proportional to how many people have actually provided that first loss capital.
Yeah, and so there's the auditors can step in there as being they're essentially randomly selected. It's a little bit like a proof of stake mechanism in typical blockchains where like they stake the token of the protocol based on the amount of token they stake gives them a higher chance of being selected, and they have to perform this task that the protocol needs. And so in the case of auditors, that's performing this task of just kind of looking at like really basic stuff about the borrower and the deal that's happening. Things like, okay, does this borrower look legit? Do they have like a real website? Do they have backers who seem like they've actually participated in other pools, or all the backers like brand new for some reason, right? There's a lot of kind of like basic information that's this human level check. And because they're being randomly selected, it would make it much more expensive to like bribe all of them, right? You'd have to bribe like the entire thing. And, the KYC aspect actually makes for a different type of security model, I think, than in a proof of stake mechanism. In the typical like proof of stake stuff, it's this pure kind of economic model where it's literally just about the money you have and how much money could you acquire to then try and sort of attack the system. But in the Goldfinch case, it's different than that because you'd have to also coordinate with people, humans, and like a lot of humans actually, or you'd have to like buy all of these addresses and buy these like IDs to do the KYC, like, but you still need to do it with a lot of humans, and it's not just this pure money thing. You can just like go to some marketplace and like buy all of these. And so that coordination cost it's an interesting thing. We've talked about it, like we're not exactly sure how to model it, but we know it's greater than zero. Like,
right.
Even it doesn't really matter how much money you have. It's still tough to like just literally coordinate with a lot of humans. And there's not like one price that every human is going to have that you could like model in anyway. And so it's been tough to like think about that sort of quantitatively, but we're sure it's more than zero. And we think it's actually pretty substantial that like having to get 1,000 people to do something all at the same time is actually like much more difficult than just like some amount of money.
Well, what we've talked
Totally.
about is like it's easier just to start up like a straightforward lending business and like borrow money reasonably well and use it for productive means than to try to like convince 1,000 people to all coordinate.
Right.
Yeah.
And it is kind of like the auditors being selected randomly out of like the people who are staking the Goldfinch token, like the kind of proof of stake mechanism, is also interesting because like the security of the network is going to scale with the value of with the total value of the network, with like how much Goldfinch is worth. And so there will just be more and more at stake securing each of these pools. And so I imagine it's going to only become more secure over time, right?
We would hope. And also we would hope that there's a larger and larger pool of auditors who are willing to stake their token, which means that the random selection, there's like a lower chance of being randomly selected at any given time, which means you'd have to either bribe more people or coordinate with more people to get that to actually work as an attacker.
So like the role of these auditors, it's not a software client you're running on your computer that's performing some automated task, right? It's like you need to do something in the real world when your turn comes up.
That's correct.
Yeah.
You need to do something. It's a human level check. I think, as much as possible, we would love to turn that into some software client that people could just run, but it's not going to be that.
Yeah. And then, okay, so this idea of the leverage ratio of like the senior pool backing the backer pools, how is that determined? So it's the number of unique backers who've kind of underwritten a particular deal. How does that work in the protocol? Have you thought about that?
And this is one of these things that we'll need to introduce, like that will need to get introduced to the community to approve. It's not in the protocol today, but
and this is all like really interesting stuff because this is where the rubber hits the road of like doing uncollateralized lending, right? Like this is like the meat of how this all works.
Yeah. Exactly.
Yeah, in a truly decentralized way. Yeah, an automated way.
Yeah.
Yeah, and so the general idea is that, say, okay, if like 2 or 3 backers are providing to a loan, like that's not really enough. Like, is there 10? That might not even be enough to call that like consensus of a group of people. So there'll need to be some parameter that's like the minimum number of backers to start seeing any kind of leverage. And then as the number, like the actual number of backers who participate in that pool goes up, then the leverage ratio will increase up to some maximum leverage ratio. So I'll just throw out random numbers. We'll have to see what the community decides for the parameters, but like, let's just say you need 100 backers to get even a penny of leverage for every $1 or $10 that goes into the pool. And then maybe as you go from 100 backers all the way up to 10,000 or 100,000 backers, let's say something crazy, you can get a leverage ratio that goes from 0 all the way up to like 8, 9, 10x leverage potentially, or maybe we start off being more conservative as a community. But that's like the general idea behind the leverage ratio, is that it is sort of on this scale based upon how many backers are in that particular pool.
That makes sense. And how do you, so the role of a backer, it's kind of this underwriting role, right? There could be people or entities who could perform that role without having like capital, right? So do you have any thoughts on how to like decouple it from needing to also put capital at play?
We've thought about that as like kind of this reputation
interesting
idea that could be introduced to the protocol. And it's the type of thing that, like, you know, to be honest, it's like, it sounds really cool and we want to do it, but we're just like, weren't sure how, like, it's sort of a complex thing to think about early on. And so we've mostly been sort of pushing it down the road, but I think the crypto landscape is going to make its own thing. This doesn't even have to live within Goldfinch specifically, right? I think what you're really talking about is it's the same kind of things that been happening in traditional finance forever, is someone proves that they're somehow good at picking things, and then they're able to raise money themselves, even though they don't have the capital, and then do a thing, right? And so I think
it could even happen offline, right? Like
could even happen totally off chain. Exactly. I bet that this is one of these things that's also going to be really coming to life in crypto over the next year or two, is like individuals just like essentially raising all their own funds on chain. I think like there's protocols that are set up to do this kind of thing now, like Enzyme I think is one, and there's like Ironbank was like sort of like this. Yearn is even really basically like this, right? Then I think this is just going to keep exploding. And so those individuals who prove themselves completely outside the scope of Goldfinch may then decide to want to participate as backers. And I think that's going to happen whether we do anything about it or not.
It's like another way to get leverage on and monetize the reputation and trust that you've built, right? In this crypto world.
Yeah, and that's also another example where that whole system of like doing funds, it works better if there's a notion of identity, and that it's like hard for you to switch to just like spin up a new address, because otherwise, you know, you could raise a bunch of money, you could lose it all, and then I'm just going to spin up a new address and start another fund and do all my same marketing tricks, right? But It would be really nice for the crypto space if there was some like hard to change address. It's like, if you lose the money, you're going to have to deal with that consequence.
Yeah, I mean, like anonymous, Sybil resistant, like proof of unique human identity is like another one of these holy grails that people have been trying to crack for like 10 years, probably more. And it's a really hard one. So I do think that it's going to go in this direction. And it's sort of like the right trade-offs are being made, right? People's information isn't being put on chain. It's one global system. Like you're not trying to control this like registry in any particular way. So I'm excited to see where this all goes. So one question on more like the building all of this, like this complex protocol. What's it been like shipping a production smart contract system that has millions and millions of dollars flowing through it? And has that experience been different from previous, engineering experiences you'd had at Coinbase and other places?
Yeah, that's a good question. For me personally, like my software engineering career I'm just actually putting this together literally right now. It's pretty much only been at companies where like we deal with money processing, because the first one was technically a healthcare company. That's how I normally think about it. But really, we actually just processed a bunch of healthcare payments. And so systems there, we're dealing with money. Coinbase obviously deal with like a huge amount of money. And I was like on the core payments team there. And worked on a lot of the reward systems and stuff for paying people out. And then now, here at Goldfinch. So like, it is interesting. I think one of the things about crypto that feels different than the other two, like Web 2 versions that still had tons of money flowing through them, is just the like lack of guardrails that are present. It's this really adversarial environment where people can all see your code. It's all like public and open source. And if you have bugs, like somebody can spot it. And then if they take the money, like that's kind of it. They just took the money.
It's so wild to me that this is the state of affairs, that any of this stuff works at all, just knowing how difficult it is to write software and that there's bugs everywhere.
Yeah. And then it's so hard to fix bugs too. Like the idea of like a hot fix in crypto is like, it's actually like, it's really different. Like usually crypto code gets audited and like it costs like an insane amount of money to deploy stuff too. It's like one of our deploys ended up costing like over 30K.
Oh my God.
Yeah, I know. There was like NFT drops happening that day and gas prices were crazy. but so the idea of like, oh, let's just deploy it again and like, let's have 5 deploys a day, like most Web 2 companies are, is just like completely off the table. So you have to take this like different approach. You can't be like quite as just like iterative and like move fast and break things. It's just like it's not really an option in the crypto world. Whereas even at Coinbase, you make a mistake and like you credit the user with like the wrong amount. Most of the time, not always, you can just undo it. It's annoying, and you can just like write a script to like fix it, or you can call up their bank and say, hey, sorry, that was a mistake, you need to send it back, and like they'll do that. So you still don't want to make mistakes because it still really pisses people off when the money's wrong, but the money doesn't feel like it's at risk of like truly being lost the way it does in crypto.
This is reminding me, Blake, of when we deployed the very first contracts we were using with our first customer, and we got some money in that, and I think it was like within 24 hours of deploying those contracts and putting money in there was like some like failed transaction from some address that like called the withdraw function on the contract. Like we never shared with anyone that the contract had been deployed. It was just like
someone was like snooping around.
I was sitting in there, and like some bot or something must have noticed a withdraw function and like called it, and like gladly we had checks in there that say you can't just withdraw the money just by calling the function, but like it's just kind of wild that as soon as you deploy the contract, immediately there's like a hack attempt just automated on top of it.
Yeah, and I actually also remember that one of those very first versions was actually Yuvzine who put us in touch with, his first name is like Bigelow from the Ethereum Foundation. Scott Bigelow.
Amazing person.
And he did this like short audit with us, and within
spot check.
Yeah, the like spot check thing.
Half-day like quick security review.
Yes, have to thank you for that, because within about like 5 minutes, Scott had been like, oh, bug there, you could lose all your money. And I was like, what?
I remember that because I was on the couch and you were like over on the table talking to him, and then I just saw Blake being like, holy crap, that was a major issue.
Wild.
Yeah.
So Scott was great, and thanks for saving us from deploying something that would have lost a bunch of money.
Well, I didn't even realize that, but I'll take credit for it indirectly.
we did have like a real audit scheduled after that, so hopefully they would have caught that too. But Scott was great and caught it before that audit happened. But I mean, that stuff's there, and if it was going to happen, then like, whoop, it's all over.
So one of the things I've admired about Goldfinch from the beginning is how consistently and quickly you guys ship, right? But in this environment that you're describing, the same methodologies of do we like deploy code frequently, like move fast, like that sort of stuff is risky. So I'm curious, like, how have you kind of walked the line between iterating and, finding the product market fit that you have while operating in this kind of risky environment? Like, what is your product development philosophy almost?
Yeah, I'll give some quick thoughts. So, I mean, definitely just general product development philosophy still is iterate and like ship as little as you have to like learn the next thing. But I also think that as the protocol has gotten more mature and there's more money at stake, like those trade-offs need to shift, right? It was one thing when we were first starting, and we actually, like the very first thing we shipped, we didn't tell anybody about it. It didn't, like, didn't really even work for like a full life cycle of a loan, but it was something that allowed a customer to draw down money and pay it back. And I think the accounting was still all wrong.
So like unaudited, like probably source isn't even verified on Etherscan. You're just like putting out a prototype to like get the money flowing.
Yeah, we got
exactly.
We had our first customer, which was this company Quick Check in Nigeria, and we got on the call with Lewis there, who like runs the company, and we're like, okay, go draw down from this thing and then pay it back, just to like make sure he could actually do it.
And like take it to the exchange and like turn it into your local fiat. We want to like, what are the exact costs? How much are you losing on that? So you make sure we get the economics right, and we're not like missing random fees, you know? And then like, okay, now like pay it back a week later, and let's make sure the interest got calculated sort of the way we thought it would, and all that kind of stuff.
Yeah.
But that was just for like $1,000, right? And we just did it ourselves, didn't tell anybody about it, but we got that full end to end, which is like, we had a bunch of great learnings.
Right. And then what happened from there?
Then we were like, okay, now let's do like a V1. And that V1 didn't have any notion of tranching in the pools, like backer stuff wasn't there yet. And like, we knew we wanted to do that. Like that was still like part of the design, but we were like, oh, this is just gonna like be so much to build. Like we just don't have time for that. Like we got to build something that's gonna work for someone before that. And so that was a V1 that was just really simplified, and that one, you know, we got that audited, right? Like we've always said, like if we're going to put real money through it, especially other people's money, like it has to be secure. That has to be really the top priority. And so then when you have that constraint, the way you shift things around is really about the features you build, and you think hard about what extra complexity are you adding, and is there ways to like reduce the amount of change in the system. But like we can't budge on the security aspect now, but you move fast by picking the right things to work on.
You do this upfront scoping of like what is the level of complexity we want to take on, what are the features. You book the audit, which I presume is going to be scheduled like 3-4 months later.
God, it's so annoying.
And then you start like working on the feature that you kind of have this deadline that you need to hit. And it's basically this internal process of developing like dog fooding, shipping to like local test net, like, you know, actual test nets, and then doing the security audit at the end of all of that. Like, is that how the flow goes?
Yeah, that's pretty much exactly it. We do a lot of unit tests. We do a lot of mainnet forking tests too. So we actually don't use testnet that much. I find mainnet forking to actually be like generally more useful, but we do testnet on big deploys and migrations as well. And we, you know, poke around on our front ends, make sure all that stuff works. And yeah, the audit is kind of the last step in that process.
But it's in a weird way, the audit is the first thing that gets scheduled. So like we have a general rule, which is like every line of code that we submit basically and deploy needs to be audited. But then these audit firms, they're like booked out 6 months in advance. It's crazy. And like we're planning what we want to build like 2-3 months in advance. So it doesn't work. But what we did was we booked out audits like once every 2 months. I think for the next year, Blake, basically. Yeah. So like we just know
we're gonna have these audits. You basically book them with your like shipping cadence. You know what the deadlines are.
Well, yeah, which I don't love. I would it's really not great. Because you know, things just sometimes you want an extra week, or you know, you have this part done and you'd like to get that audited a little earlier than the actual audit. But it's very annoying. This is like a huge problem in the industry, I think. But luckily I'm seeing more audit firms come up, which makes sense because they're like making a boatload of money right now.
Yeah. And then, so then our process, now that we have these dates for the audits, then, and we know that every single line of code has to go through an audit before it's going to get sort of actually deployed to mainnet. Then like Blake was describing, it's this iterative thing of like, from a feature standpoint, the philosophy is like, what's the very next thing we need to learn or need to test out on the protocol? Like what's the minimum version of a feature that could do this? And then what can we build, and what can we build before the next audit date? And then basically just build that. And so we're not sort of minimizing the security there, but we're minimizing like the actual feature set that we do with each iteration.
Seems kind of nice in a strange way, right? Like it's the constraints breeds creativity, and it like brings more discipline into like actually choosing what you're going to work on, prioritizing. Having a deadline is kind of nice in a weird way.
Yeah, I'll take that as a silver lining.
It's a silver lining. I mean, it's really hard to adapt quickly to things. Like when we see something and we want to like change something, but like, oh, we only have a month before the next audit. We were planning to do this thing. If we want to like build something else before that audit, like it's actually like, pretty challenging. And so
Yeah.
it makes it really hard to adapt, even if we have things sort of planned out. But it is nice to have the cadence and have a forcing function that means, okay, we got to get this code out and audited before the next thing, like forces you to iterate.
Yeah.
Maybe the ideal there would be if we had the cadence and I could do like plus or minus 2 weeks.
Yeah.
Right. Cool. Yeah. So the next and last kind of big bundle of things that I was hoping we could talk about was you kind of opening governance and launching the token, which happened relatively recently. So
Yeah.
I'm curious, first of all, just from a personal, like emotional going through this crazy process of having a token out there on like CoinGecko now and like entering this wild world of crypto. What has that been like?
So it was like so much more work than we thought it was going to be. It ended up being like a 5-month project. I think we were talking to you about this like a few months ago. We were like, oh, I have it done in like another month or two, and no, it was like another like 3 months. But so one, it was just a bunch of work, and I feel like it was a huge milestone for the team. Everyone was just like so happy to finally just like get all this stuff out there. There was like so much material that had been written both on the front ends, the smart contracts, docs, announcements, wrangling up media, right? Like just everything, right? There was like so much stuff, and I'm not sure I've fully appreciated the like complexity that a token adds to a project. I'm just sort of coming to recognize that now, like post token launch. I'm realizing that like there's just like multiple layers of complexity that weren't there before. Specifically, the stuff I think about, there's kind of this like community politics layer that comes into play now, because if tokens have been delegated to one group or another, there's like this implicit sort of like ranking of like who's important and like not important, and like how much you give, and like as new features need to come out, there might need to be adjustments to those token allocations, and like all that stuff is like super important to people. Like it's money now. It's like a lot of money actually. So that politics angle was something I hadn't really fully appreciated, I think. And then also thinking about the economic complexity that comes with this, and like the second order effects of token price, right? Because token price can affect the APYs that are seen on the senior pool or as backers, and like that stuff can be reflexive, like up and down. And then thinking about, oh, well, do you have like vesting or not vesting? And if there's vesting, then it'll like reduce token supply. Maybe that keeps price up, which keeps APY up. Or but if you reduce vesting, maybe that increases capital in that you can use to lend out, but also maybe it puts more tokens on the market, which can decrease the price, which can then affect the APYs and reduce the amount of capital that comes in. So like there's all this like very self-reflexive and complex
monetary
system.
policy.
Yeah. And of course, all this stuff, as you're saying, it's now like a community run protocol, right? And so token holders can vote on changes to the protocol. Any change to the smart contract stuff is going to be voted on by the community. We're using quadratic voting to do that, which I'm like super excited to be one of the first protocols to be able to really do that with fully on-chain data because of UID. We've already actually had some of the first votes have gone through, and it's really cool. So yeah, I don't know. I think those are just some of the key learnings I'm thinking about. It's just, man, the token adds a lot of complexity. It's hard to wrap your head around.
I mean, there's the complexity of the economics of it, second order effects, and part of like the sort of politics thing, and we're working with the community, is we were talking about how difficult it is to plan the work that we're doing just around audit schedules and around like product iteration and trying to adapt quickly. And then we add a whole new axis here, which is like everything that we want to do from like the Warbler Labs team. Like we're just one among the whole community. So now not only do we want to try to like do things that might be improvements for the protocol, but we have to plan through, okay, how do we propose this to the community, and how do we make our case, and how do we get them to be excited about it so they vote it in? And so that's like a whole other element that I'm also starting to learn, like, oh, okay, we like the process on governance is like you make a proposal and you open it up for discussion for a week, and then after it's discussed for a week, there's like a 3-day vote. And so then, okay, now there's like a week and a half, if everything goes perfectly well, that we need to incorporate into our planning for just general community discussion of things we want to propose to the community. So I'm just starting to sort of internalize that aspect of the complexity too, of like shipping new things.
Yeah, it's a lot of complexity. Yeah, how has the community evolved since this token being out? Right? Like with people having financial stake in this thing.
In the last 2 weeks, I haven't seen a big difference, except less questions in the Discord about like when is there going to be a token?
When token.
Yeah, less of that. They now know. But I mean, the community has been pretty engaged for a while now, and I think a lot of them are excited about the mission of Goldfinch. I think that's pretty much remained the case even after the token, and hopefully it grows from here.
Yeah, another thing I was curious about was liquidity mining and like these incentives for growing the protocol. And you
Yep.
also alluded to other potential ways of doing this when you do have KYC, right? Where you could do affiliate programs or which is a totally unexplored, territory, which
Yeah.
I think
Yeah.
you will probably be well positioned to explore. But I'm curious
Yes.
how the liquidity mining stuff like has gone, what sort of an effect has it had on the growth of the protocol, on the sorts of people who are engaging with Goldfinch? Because it's always like a big variable to turn on these sorts of things. I'm curious what like your actual experience has been.
Yeah, it's been super interesting. So let's see, as part of launching the token, the protocol added liquidity mining, which is it allocates the GFI token to folks who provided capital into the senior pool. And it's this like interesting kind of a dynamic rate where the protocol sets a target. So right now the target is at $100 million. And then as the protocol reaches its target, the actual distribution rate declines. So that like the protocol isn't like quote unquote wasting tokens on a lot more capital than it actually needs. And such that if the senior pool were to reach double its target, like $200 million, as it gets towards that $200 million target, the protocol decreases the rate to zero. So in theory, if there were $200 million in the protocol would just stop distributing GFI altogether. And so that would be like, oh, there's way more capital than necessary. It just saves tokens. So that is to try to get to kind of like a market equilibrium of like the right number of tokens to get the right amount of capital relative to the target it actually wants without wasting tokens for like a lot of excess capital that the protocol isn't putting to use. And so we're pretty excited about this general dynamic and launched it. And what we're seeing right now is before launching the token, there was $40 million in the senior pool. More capital came in, $65 million are now in the senior pool. And the overall APYs there, including the token, are in the range of like 60, 70 to 80% APYs. And our early predictions were that the APYs would be lower than that, like that the capital would be seeking lower APYs, but we're seeing this kind of like higher APY. And so it's interesting. So we've definitely seen more capital come in, which has been, I think, overall like a success for it. But we're looking to see like what, like how do the LPs kind of sort of compare the APYs here to other protocols? And one, like we've been basically trying to reach out to different LPs to understand how they think about it. And one thing that I found interesting is the way that it's implemented on Goldfinch is it has this sort of 12-month unlock period, which is that you need to leave the capital in the protocol for 12 months before you can claim all of the sort of tokens that you've sort of received through liquidity mining, which is different from other protocols. We think this is a direction that protocols are headed in general, but it means it really needs to attract like longer term capital into the protocol. And so I like my personal hypothesis is like that was one of the reasons why the required APYs are so much higher. But then when we were talking to some LPs who have supplied, they were saying we were like, oh, do you think this vesting thing or like this unlock schedule is a problem? And they're like, it might be, it might be reducing the amount of capital that comes in now. But they were like, I like it. Like it makes me feel really good to know that like all the capital in here is long-term oriented. And I personally like that there's that vesting schedule because then I know that I'm participating in this sort of like long-term mindset alongside other providers of capital that have that long-term mindset.
More stable base
like,
to build on.
Yeah. So I thought that was pretty interesting, which is
so wait, what does that mean? So if you withdraw like a month in, what happens?
It means you forfeit that percentage of your rewards. So if you were to like withdraw halfway in, like 6 months in, like 50% of the rewards you would have earned are forfeited. If you withdraw 9 months in, 25% of the rewards you would have earned are forfeited. If you withdraw 12 months in or anything after that, there's no forfeit.
Got it.
So yeah, you can withdraw at any point in time, and all your underlying capital is available to you, but the reward part is what will be reduced if you withdraw quicker than 12 months.
Yeah, makes sense.
Yeah, my kind of like hypothesis as we've been talking to folks is that when we implement when it's implemented this way, what you see is kind of like a bit of like slower, steadier growth, but like sort of much more stable capital that comes in. So like, for example, if you just recently with the markets declining like pretty soon after the tokens launched, the capital, not like very little capital was withdrawn from the senior pool Goldfinch, even when like overall sort of TVL in the space fell quite a bit on other protocols. And so I think that kind of speaks to when there is this unlock schedule, the capital coming in is slower, steadier, but also just more stable and more long-term oriented. And so, yeah, we kind of like saw that in action during that broader crypto market fall.
Also, I mean, speaks to how Goldfinch is uncorrelated with the rest of crypto, right? Because the borrowers aren't getting liquidated, but the price is falling. Like if anything,
yes,
it's making Goldfinch seem more appealing because you're getting yield from something else.
Yeah, the base interest rates on the USDC haven't changed at all.
Yeah. One question was how do you think about Goldfinch in the context of the potential like macro environments, like all of the crazy stuff that's happening?
One of the things Mike and I have talked about a lot is just seeing, when you talk about this broad macro environment, is these kind of like mega trends we think over the next 10 years, where like one is that you have basically investors we think are just going to start demanding new sources of yield. I think you have like bond yields are going to be super low. I know the Fed's talking about raising rates, but like I don't think they're really going to do that much. And when you combine it with inflation, I think the net yield you're going to get on bonds globally is still going to be like super low. And you're going to have all this capital like looking for new ways to earn yield, both in like institutions as well as individuals. And so I think that trend is just going to continue, right? And technology, of course, is going to make it easier and easier for people to get access to yield too. So that's going to be one big trend. And we also see just a ton more economic activity starting to move on chain. And we were kind of talking about that earlier. There's still a few kind of missing pieces to like for that be ready for prime time, but we feel pretty confident it's going to happen. And when you have all these economic activity moving on chain, that means like all of those transactions are now programmable through the magic of the blockchain. And you have all these investors now looking for yield in new ways. And that means that those investors could be like lending against these transactions that are happening on chain. And basically every transaction in the world is now programmable and can have a loan against it. And so when that's possible, we think like you're going to need a marketplace to organize that activity. And that's really what we see Goldfinch as fulfilling. It's fulfilling that decentralized marketplace to coordinate all of this debt activity for all these lending transactions around the world. And we've even talked about that as being basically like an open source Visa rails, right? All these transactions are happening. Smart contracts can be written with different strategies of how to lend out to different people and institutions, and people can be then doing wholesale lending into those smart contracts when you have this full life cycle of funds on chain from like, person borrowing and paying, and their income is on chain. And like, so there's a lot of pieces that are getting there, but like, we think that's where this is headed.
That's a really exciting and big vision. Super excited. Well, yeah, thank you. We've been talking for a long time, so we can probably bring it to a close. I'm super excited about Goldfinch, and we'll be following closely.
Thanks so much, Tina. This was a ton of fun.
Yeah, thanks for having us on.